Why is no one talking about the fact that it's not worth investing in 2025? It's a new year, a new president, a lot of new challenges and changes. Markets have changed, the world has changed, the leadership of our country has totally changed, and that means a drastically different environment for us than in years past. So today I'm going to share why it's time to stop investing and how to adopt a different strategy to maximize the rate at which your money grows. If our goal is to get richer and grow our net worth, then we have to do different things with our money this year than we did in 2020 or 2015 because the tables have completely turned. So what are we up against? What's changed? What has made this switch happen? Why is it not good to invest now? Number one, we've had incredible market growth since COVID, and that kind of growth can't persist. We can't have a 23% gain every year, year over year, so expecting that going forward is backwards. Number two, the AI boom might be over. It's been short, it's been sweet, but just look at NVIDIA in the last few days. It's gone down a massive amount when a competitor has popped up, and maybe that's going to be the same story for a lot of other AI kind of speculation that's been thrown to the market thus far that's propped up stock prices, and maybe that's more fragile than it seemed. Third, inflation has been crazy. We were spoiled back in 2020 when inflation was 1.2%. That was kind of the norm for much of like my professional career. Then 2021 hits, 4.7% inflation. 2022, 8% inflation. 2023, 4.1% inflation. And on top of that, additional tariffs on any international imports would, at least in theory, increase the price of those goods for us. And that we're the end consumer. And that means that we can then buy less stuff with the same amount of money that we have, which could then slow the growth of the companies and also the stock market. And we wrap all that up with a bunch of other data too, and we ask financial experts like those at Vanguard, what can we consider happening in the future? Like, what should we expect? They think we should expect much lower growth than we have in the last few years, like a fraction of it. And on top of that, something like a recession isn't an impossible consideration. So that's the market side of things. That's the big picture things. What about the average American in our finances? Well, I did some digging into the average American debt levels, and it is not necessarily pretty. American consumer debt is now at all-time highs, along with interest rates being incredibly high as well, and that's putting Americans behind financially. My generation, the millennials, have done fairly bad with a general increase in our debt of 5.3%, but Gen Z has totally crushed us. They're off to a really scary start in 2024, taking on more debt than any other generation by far, with a 30.9% increase from 2023. Yikes. Now, part of that might be that Gen Z people are buying houses. That's kind of a different consideration than just taking on normal consumer debt. But still, that's a massive change. And the two forms of debt that Americans as a whole took on most in the last year is home equity loans and credit card debt. To drill down into that, we all know that the rate that we pay on a credit card balance is insane. It was over 24% on average in 2024, but with interest rates being so high for all forms of debt, HELOC rates weren't much better. They're also completely insane, with the average HELOC rate being 8.44% in 2024. Okay, that's a lot of information, but let's move into part two of the video, which is saying, what does this mean for us? What does that mean for what we should do with our money going forward? Well, to me, in a nutshell, what this is telling me is that investing is less attractive than it was 5 years ago or any time in the recent past, and paying off debt is astronomically more attractive for the average person than it was 5 years ago or any time in the recent past. And what this means is that all the conventional wisdom that's been preached over the last 15 years, claiming that it makes sense to invest more so than it does to pay off low interest debt, is now wrong. How do I know that? Well, in complex matters like these, I like to rely on the simplest math possible. We just focus our effort and our money on which is the bigger interest number, our debt or our investing. Any debt we have in our life that we signed up for in the last couple years is draining our money at the rate that we're being charged interest, likely 8 to 24% per year. And then our investments on the flip side are making us money. They're growing our net worth at the rate of return that we're getting. Last year, the largest 500 companies in the United States, the S&P 500 as a whole, had a fantastic year and earned more than 23% returns for anybody who's invested in that through like an index fund. But that's an anomaly year. We can't count on that. It was one of the best years in stock market history, and the average investor who picks a few stocks and does some little creative stuff on their own often has negative years of investments. They aren't using something like an S&P 500 index fund for all of their money. They're not getting 23% last year. And based on what we can see, based on Vanguard's outlook, based on all these factors that are playing into what the potential investment market looks like going forward, I wouldn't be surprised if our expected returns from investing are 8%, somewhere in that range. So our debt then is driving down our net worth at a rate of 8 to 24% per year. And our net worth is growing through our investing as a positive 4 to 8% per year. We focus on the bigger number because this is losing us money faster than this is gaining us money. It's like if you were running on a treadmill and the treadmill was turned up so fast that you can run as fast as you want, as fast as you possibly can, and yet you're actually still gonna be moving backwards. That's the financial situation with debt versus investing right now. So specifically what I'm talking about doing here is making extra payments towards your debt. And what that's going to do is pay it off early, save you money on interest, and then free up that money that you were using to pay off that debt to then roll into the next debt and pay that one off even faster. And keep doing that until you've paid off all of your high interest debt. The analogy that I think about when it comes to high interest debt is it's like if your house is on fire. Right now, it's not a huge fire, but it's literally on fire. You're standing there with a fire extinguisher. If you don't use the fire extinguisher to put out that fire now, it's only going to grow and grow and grow until it destroys your entire house. The fire is proverbially your high interest debt, threatening to get out of control. Your fire extinguisher is the cash that you have from your job that you can apply to that, or you can invest it, or you can spend it on lifestyle stuff. But where you choose to apply that focus and that fire extinguishing power is going to determine the outcome of your entire financial life, because if you don't put it on that high interest debt, it's going to consume you. If you want a way to track your progress when it comes to finances in general, I recommend tracking your net worth. This is going to reflect the debt that you're paying down, as well as the investments that you make that make your value of your investments go up. But if you're not tracking that one number, that net worth number, then I think it's hard to kind of gauge your progress. It just feels like you're aimlessly making payments to this person and that person, and money is flying out. But what's happening? The one net worth number will tell you how well you're doing. If you want 11 tips on how to free up money to pay off your debt faster, to grow your net worth as fast as possible, then watch this video next.